Rick, we're back, man. Yeah. Podcast number 2.
Yeah.
It's been a little while. I know that you and I have been really busy on a conundrum of different things, and finally finding a little bit of wrinkle in time to actually talk about some very pertinent information out there today.
Yeah, things keep moving, things keep changing, and a lot of this information isn't just out there for people to know about. So it's always good for us to get this stuff out to people so that they're aware of things they could be subject to.
Absolutely. I mean, I think at the end of the day, what Rick and I, what we're trying to accomplish is we're just trying to educate the public. There's a lot of bad information that is out there. A lot of not even people that are CPAs, EAs, or even preparers that are just taking just one little nugget of information and kind of twisting the narrative, right, to make it sound like, oh, all these amazing opportunities to kind of, in a sense, frauding the system. Mm-hmm. And so we're here today just trying to kind of set the record straight, let everyone know what the rules are, and try to make this somewhat entertaining.
Sure.
By the way.
Absolutely.
All right. So we're going to kind of move along. And what we did is we created this PowerPoint that you, as the viewer, can also see in the background. We didn't do that on the first go around, but trying to do things a little bit different this way so it's easier for people to follow. So one of the things that's really new, and everybody's talking about it now, Rick, is the BOI, the new rules that's out there. Why don't you kind of go over a little bit of that, if you don't mind?
Sure. So this is a law that's actually been around for a couple of years and has been pushed out at least 2 years since it was passed for different reasons, but it has gone into effect for 2024, right? And so basically the BOI rules basically require any entity, DBA, business, if you have some sort of EIN or doing business as a whether you're a sole prop or all the way up to a C corp, you have a filing requirement now to file with the Department of FinCEN, who, for the most part, what they regulate is our financial currency, right? And mostly the financial crimes divisions. The big thing here is money laundering, right? There's been an influx of LLCs that have been created across the United States by foreign nationals in order to funnel money out of the country through money laundering schemes. And so what they're trying to do is crack down on this. But just like anything that the government does, they took a heavy hand.
They did.
They took a heavy hand and applied it to everyone. And so now everyone's paying the price for some bad actors.
Yeah. And so if you're not familiar with BOI, BOI stands for Beneficial Ownership Information. And as Rick was alluding to, it is required by the U.S. Department of Treasury Financial Crimes Network.
Yeah.
So like Rick said, there are new rules in place. And so these new rules for newly formed entities in 2024, I think what they had said is they wanted you to register within 30 days. Originally, has now been pushed out 90 days. If you already had a entity that was registered before 2024, it is now due by the end of this year. Is that correct?
That's correct.
And so, guys, I can't emphasize it enough. You want to make sure you get this in. Your CPA, your accountant should be able to prepare this for you. If they cannot, you might want to find another accountant. Yep. With that being said, realize it's not part of tax return software.
No, it's completely separate.
It is completely separate. I know that we've already prepared a few for some of our clients. Approximately around 6 pages. You have to kind of go through iterations of copies of driver's license and all pertinent information for owners per se on there. And it's a way that they can go back and tie everything back to who owns what.
Yeah, and to kind of back on that, be careful. I know a lot of attorneys are pushing this right now, that they will prepare it for any of the entities that they've created for their clients, especially if they're the registered agent or any of that nonsense. The problem with those things, of course, is if the attorney isn't up to date with your business. And this happens a lot where a person meets with an attorney 5 years ago, they form an LLC, and they haven't even talked to that attorney since then. Yep. And the attorney may not even know you've got a new partner in there, or you've moved from where you were 5 years ago.
Or you have an equity change as far as ownership because you have a threshold. If you're below that threshold, you don't have to report.
Yeah.
And so you now have an equity change of ownership, either a new equity owner or someone's amount is less than the required amount. And so you need to file an updated FinCEN report for those transactions that occur.
That's right. And so if those BOIs get filed and they're incorrect, you would be subject to the penalties that are there. But on top of that, let's talk about some inactive entities and some that might not be before we're talking to penalties. You okay with that? Oh yeah, sure. Yeah. So from an inactive standpoint, it's 12 months, right? So if you haven't done business in your LLC, that means you haven't run money through a bank account. Mm-hmm. And I think it's $1,000.
Not engaging in any active business.
Correct. Then you're not required to file this. Okay. So basically, if you have an LLC that maybe you formed it a couple of years ago and you haven't really done anything with it, you don't have to file this report. You certainly can. You don't have to file the report if it's basically an inactive or a dead entity. But again, the threshold's $1,000, so that's not a lot. You may think, well, all I'm doing is just keeping it active. Maybe I pay my accountant to file the return every year, whatever. Well, if you spend more than $1,000 with your attorney or your accountant every year, that's an active business, regardless if it's zero income.
Yeah, and I'm going to take it one step further, Rick. I would say if you're uncertain on the matter, let's go ahead and file. Mm-hmm. Because here's the deal. If there's not a lot of changes or really any changes that necessitate the following year, you might have only had to file that 1 year.
Yeah.
And so it's done. It's over with. And you don't have to resurface it unless things change in your business. So I tend to lean on, let's go ahead and get it done. Let's be proactive.
Better to be safe than sorry.
Absolutely. And I think the government will also take that same position if you're proactive, trying to do the right thing.
Yeah.
Okay. So that's Rick and I. That's our take on it. Yeah. And anyone that is giving you advice should probably do the same. Now, just earlier, you were talking about penalties.
Yep.
Okay. And I know they came out with some very harsh penalties, Rick.
Yeah.
With those harsh penalties, they've now changed a little bit. You want to talk about where they were at, how they've changed, the dates, and the worst things that can happen?
Yeah. So the original, when this first came out, it was you had 30 days from the time you created a new entity. So that if a new entity was formed this year, you had 30 days to get this filed. And then existing entities before this had until the end of the year to file. And the penalties were $500 per day that it's late, up to a maximum of $10,000 a year and potential imprisonment time of up to 2 years, depending on how egregious you were in not filing this BOI.
Really up to their discretion.
Correct. And the government, if they get the chance, they're going to hammer down on you. It's money for them. So those actually changed in January, right? So we went from $500 a day to now it's $591 a day.
Great inflation we're dealing with.
And the maximum is still $10,000, right? But I want people to realize that's less than 20 days. Basically, if you had a filing that was required and you waited a month to file it, then you're already late. You already owe the maximum penalty. Now, great change that happened is they extended it from 30 days to 90 days for a new company. You still have until the end of the year for existing companies to file this, right? But if you're filing the BOI with your tax return, which is what we're recommending, then that will be taken care of for you and you won't be subject to these penalties.
Guys, and I know right now with inflation and everything that's going on that everybody's pinching their pennies, and rightfully so. We are as well, okay? We're all in the same boat together. With that being said, I not because we're in this field, but I can't emphasize it enough that you need to make sure you have the right accountants, the right people in your field to help guide you along the way. Because if you think you're going to, cut a little corner here and there, it could come back and bite you in the rear. Maybe whoever you switch to is offering to do their taxes for you really cheap, but that BOI is not included in there.
Yeah.
And now you get hit with this $10,000 fine. Sometimes you got to be careful what you ask for. So, for our firm, what we do is we want to be all inclusive. We just want to take care of everything for the client.
Yep.
So they don't have to worry about anything. Okay. And I think that's one of the things that set us apart from a lot of other accounting firms is we're a trusted advisor. We're an advisory firm first. Okay. So we want to advise clients in the right direction. And then the compliance stuff just comes afterwards. Okay. But you should have someone that's advising you and overseeing things and actually cares.
Yeah. Well, and that's one of the things that I talk to potential new clients as they come in the door is make sure you're asking the right questions, make sure. And the problem is a lot of people, they don't know what they're required to file.
Yep.
That comes in all the time of sometimes they don't even know what their entity is. They know they have an LLC, but they don't know if it's an S Corp or a C Corp or a sole prop. They don't know any of that stuff.
Yep.
But you need to be making sure that whoever you're using is answering the right questions for you, right? What is included with their services? Because if they miss something, even if it's a basic in the state of Texas, we have franchise tax reports.
Yeah.
If that doesn't get filed, you can lose your LLC.
Guys, and here's the difference between a trusted advisor and someone who's just doing compliance work. Who's ever representing you should be trying to educate you. Okay. And that's one of the things that we work really close with a lot of our clients is where there's an educational piece. We try to educate you all as much as possible because if we can do that, believe it or not, it makes our job easier.
Well,
right?
No, absolutely. I mean, it's so easy to streamline the things that we do with clients when they're as educated about the process as we are.
Yeah.
Right.
Yeah.
Because then there's no surprises. And I tell clients this all the time. At the end of the year, when we file your tax return, there should be no surprises on that tax return. You should already know what it's going to look like.
Right. And one of the things that I, tell all of our staff in all of our meetings, and this, is that tax return, it tells a story, it tells a financial story, right? If it's a business, it tells you where your income items are, what your expenses are. Your balance sheet is going to show you what type of assets that you hold, what type of liabilities, whether it be short-term, long-term liabilities, what your equity stake is, any contributions that you made or any distributions. And so you should ask yourself when you look at that tax return, if you can't, then whoever's preparing it should be able to explain this to you in great lengths. Is that tax return a proper representation of what happened in your business in that respective year?
Yeah.
Because it should tell the story.
Absolutely.
Right? So if all of a sudden it shows $700,000 in net income and you're going, whoa, wait, I think I only made $100,000. You have a disconnect there. Something's been booked incorrectly and needs to be reclassed. So you need to dive deeper into that and figure out what's going on. And so that's where we're a little bit different than most firms. We try to uncover and see what the client is actually doing so we can give them the proper guidance.
Yeah.
So enough about that. Sorry. Now, this is a very hot topic right now, Rick.
It is.
The Venmo and Cash App payments that the government was cracking down on, basically alluding to that $600 payments in any one of these merchant accounts was going to be represented via 1099-K. They've pushed it out a little bit now.
Well, not only that, if you're a user of some of these apps, a lot of these apps have added to their software certain questions about what's this transaction for?
Yes.
Okay.
Yes.
And you're required to report that because they want to know if you're trying to run a business through these apps, right? And so they know whether or not they need to 1099 you or not. Versus what most people use these things for is basically buying and selling goods, right?
Mm-hmm.
I want to buy a pair of shoes from my neighbor, and I'm gonna
or for services.
Yeah, I'm gonna cash app them $50 for the sneakers that I'm buying from, right? Well, that's not a business, right? But if it looks like you're doing the same thing on a regular basis, these things are going to get flagged, and suddenly whether you wanted to or not, it creates a business for you. The great thing is with this change now, the limit's going from $600, which is what the old 1099 reporting things were, to $5,000, right? So you might still be able to be under the threshold and avoid some reporting.
But that's just for 24.
But that's just for 24.
Yes. It's going to drop right back down.
Correct.
To 600. So what they're essentially doing, folks, is they are easing it in, right? They listened to everybody. There was a lot of backlash, but ultimately that's their agenda, is to make sure that they're capturing all income.
Yep.
Okay. And so the $600 is coming. It's just not coming in 24. It's coming in 25.
Yeah.
Okay. So be prepared. But it's going to be 5,000 for 24 for now. This was something when I was doing some research, this little topic right here makes sense, but right now you need to be very cognizant on tax penalties, right? It's at the highest that it has been over the last 16 years. Mm-hmm. It's at 8%, and that's been going on from October 1st of 23 over to March 31st. To put things in perspective, guys, in 2022, penalties were 3%. Mm-hmm. So it's escalated from 3 to 8, Rick. That's pretty substantial. And it's going to fluctuate with interest rates.
Well, I think what the IRS is seeing is that there's a influx of returns that have been filed in the last 2 years where the amount of people that owe has increased on their taxes. And a lot of that has to do with the changes on your W-9 and W-4 reportings. A lot of people are becoming much more self-employed, so they have self-employment taxes that are owed. And so what ends up happening is you end up owing, you owe a penalty for not making those tax payments within the year. Okay. So you have until January 15th of this last year to make all your payments for the 2023 tax year.
Yep.
And so if you end up owing, you file your tax return April 15th and you have a balance due, this penalty comes into effect because you should have remitted those taxes during the tax year. Okay. So you're going to be subject, let's say you owe $1,000. Not a lot, it's $1,000. You're going to get an extra $80 penalty on that.
Yep.
Right?
Yep.
Because you should have paid that $1,000 before January 15th.
And hey, listen here. What I always try to tell people, if you're uncertain on what your income is going to be for that respective year, let's fall under the safe harbor rules.
Yeah.
Let's use 110% of the previous years, but let's also make sure we're making our estimated payments on a quarterly basis, okay? So it's not just that you wait till the very last quarter and then make that 110 payment, right? Or make sure you have 110% in. It should be done throughout the year on 4 quarters because they don't want to miss out on you've underreported for that respective quarter.
Right.
So you will still be hit with some penalties if you don't make those adjustments accordingly.
Correct.
Rick, the expanded tax credit for tax years 2023 through 2025 for children and for kids. You want to hit on a little bit of that?
Yeah, I mean, this has
small
been
increases.
I mean, this has been needed for a while, and most people are going to look at this and go, "It's not much of a break, right? We're going up $100. It's not a whole lot per kid." We've been kind of stuck at this $1,800 amount. I don't know. At least a decade, right? It's been a while. I know we got a little bit of break during the COVID years where we got a little bit more as a refund, but then they went back to the old tax rules. And while this wasn't really an inflation adjusted amount, it is a way of getting certain taxpayers a little bit more for claiming their children on their tax returns and getting that tax credit. And this is for the refundable portion, right? So, the refundable portion was always limited at $1,800 plus whatever your income might, adjust it down a little bit. Mm-hmm. Now that amount's going to go up to $1,900 and then eventually to $2,000 over the next couple of years. It's not much of a break, but it's a little bit of a break.
Every little bit helps,
Sure.
And it's, and I'm sure they'll reassess everything forward after 2025, but realize it's 2023 through 2025.
Right. And I want to point out, this hasn't gone completely into effect yet. This is just the change that's totally been discussed at this point.
Yes.
It needs to be done. Honestly, it's a piece of legislation that keeps coming up and keeps getting shut down. But it is out there to be passed.
Yeah. And I think the odds are pretty high. So I know the next question that a lot of people have asked about is, should you hold off on filing your tax return until this is done? And I say no, actually.
No.
Just go ahead and do it. I'm sure the IRS will make an adjustment and then pay you the delta.
They will. Yeah.
Is what will happen.
Yeah.
But it shouldn't hold you up. And as Rick alluded to, and we're not trying to minimize the $100 increase here, but go ahead and file your taxes. The IRS will make the adjustment, and you'll receive a supplemental check, or you should.
That's correct.
Assuming it passes, and the odds are pretty good, or we wouldn't be talking about it.
Yeah.
Okay. OnlyFans. Wow, it seems like everybody now is on OnlyFans, or they're an OnlyFans person. It's hot button topic out there right now. Not saying it's one that I care too much for, but at the end of the day, people have to make their money.
Yeah.
But there's a lot of questions like what is an OnlyFans person in the IRS's eyes, right? Well, they're a content creator, right? Yeah. They're creating content. Most of it's sexual, but it's still content at the end of the day. And so if they don't file anything, they're going to receive a 1099 NEC as a contractor, right? They're a sole prop. But you can also, Rick, set up an entity like an LLC taxed as an S corp. Mm-hmm. Pay yourself a salary out of there. Mm-hmm. Okay. There's ways that you can minimize your self-employment tax by doing that.
Sure.
And realize that you have deductions. You get a portion of your costume, or your home office, your cell phone, meals, your car, wherever you're producing this content, right? Sometimes we don't want to think where they're producing the content, but the reality is they're producing content. If they have a specific room they're producing this content in, right? That becomes almost like a home office.
Sure.
Wherever they're producing content, they have a legitimate expense.
Yeah. So OnlyFans was the target of some of this stuff just because there's so much money kind of being generated. But the truth of the matter is this is for all online content creators. You could be a YouTuber. Yes. You could be a Facebook's person.
All the same in the IRS.
They're all the same, right? Yeah. So don't get confused of saying, well, I'm not an OnlyFans person, so this doesn't apply to me. Anyone that creates online content and then somehow, whether you're selling it through YouTube, you're profiting, you're generating some revenue, you're going to be subject to all of these rules. Now, having an LLC or some kind of corporation or something will definitely protect you. I want to kind of touch base though on some of the home office stuff, because this is where we always see this fallout. Everyone wants to claim their house as their home office, right? Mm-hmm. And I'm going to apply this to the OnlyFans. If you're using the bedroom as your content place, and that's also the place that you're sleeping, that's not a home office.
No. It needs to be an exclusive area. Typically you have a closed door, yep. And that's all you do in that office or in that specific room.
That's right.
So look, IRS is very clear that they want this to be a clear and defined area. They don't want the commingling of personal activities with business activities in this regard.
That's right. And just like with any business owner, we strongly recommend, all of your finances are separate, personal and business. Absolutely. Separate, no commingling of funds. So if you have, if you have an OnlyFans or a YouTube or whatever it is that you're receiving revenues out of, have a business bank account that those funds are being deposited in. Don't send them directly into your personal bank account. It's a great way to lose a deduction. Absolutely.
You want to segregate that and segment that per se, because if you're ever audited, it's very difficult to prove. If you start commingling your personal with business, they're just going to start throwing that out and say, no, that doesn't apply. How do I not know that wasn't for personal?
Yeah.
And I would do the same if I was in their shoes.
No, absolutely. Yeah.
And so you need to represent your business as a business, act as a business, and conduct it as a business accordingly. And so this goes for the content creating for OnlyFans as Rick said, any content creators at that point.
Correct.
So good information. So the tax brackets. So the reason that we're putting 2023 tax brackets, look, everyone, I know that we're at 2024, but everybody's thinking about their 2023 taxes right now. So I thought it kind of made sense for us to kind of talk about 2023.
Yeah.
We won't go into details here. We'll just kind of highlight a couple of things. But as you can see, you have different tax brackets for single filers versus married filing joint filers versus head of households. Okay. And it is a graduated system from 10% up to 37%. And so just if you're looking at this graph right here, basically you'll go through the iterations of the income from 0 to 11,000 is going to be taxed at 10%. If you're a single filer, 12% will then kick off at 11,000 to 44,000. So just that segment right there will be taxed at 12%. So that is how this is read, right? So you break out each segment, and the segment prior to that is going to be taxed at the percentage rate based upon the column that they fall within, whether it be a married filing jointly or head of household or single filer. So as you can tell, as your tax bracket gets ratcheted up, it's that much more important to have CPAs, EAs, tax advisors, someone that you can count on to help guide you and make sure that you are limiting your exposure legally. Because as you can tell, it's just say it's an expense. If we're talking about $100 and you fall within the 37% tax bracket, that's $37 on $100, right? So that's a pretty substantial amount.
Yeah. And
right?
This is what we use when we look at structuring, right? When we look at how a person's going to file their personal return, what income comes into that personal return. And then should we be looking at structuring any income outside of, say, a W-2, anything else, we need to find a way to structure it in a different way so it gets taxed outside of these brackets.
Yeah, and that's why it's so important. And so like we talked about when we kicked this podcast off, we're an advisory firm before we're a compliance firm.
Correct.
Right? And so that's so important, especially if you're in these higher tax brackets, okay? It's not just you're doing a TurboTax or H&R Blocks tax. We advise clients. We try to get them the best possible tax, most advantageous situations that we can, and work with them throughout the year. It's not just a one-off.
Yeah.
We want to educate them. We give them educational pieces. So that's where I think we're a little bit different than most.
Yeah. I mean, a lot of this, and people don't understand, it doesn't take much to crawl up these tax brackets, especially since most families are dual income families, right?
Yeah.
Usually both the husband and the wife work. And you may think, well, we're just middle class. Well, the IRS has a different definition of what middle class is versus us, right?
They do.
And so it doesn't take much to crawl up many of these tax brackets. And the jump from 24 to 32 is that's an 8% jump, right? So, just on $364,000, if let's say you and your wife both make $200,000. Maybe she's an RN nurse practitioner making $200,000 in a hospital, and you've got a small business that you make $200,000 out of, right? Well, now you're sitting in that 32%. That doesn't mean that all of that money is subject at the 32%, right?
No.
But if I could drop down to the 22% at 190, that means that $210,000 is getting taxed above that 22%. And if I can save you 8 to 10% on that money alone, that's $15,000, $16,000 a year in taxes that I could save you just by doing some structuring on some things.
Absolutely. Right. Absolutely. Man, this is a topic that a lot of people have asked me about. And it's happening, right? There's been a lot of budgeted dollars right now. The IRS is ramping up, right? So the IRS announced that they're having a sweeping effort to restore fairness to the tax system under the Inflation Reduction Act. New compliance efforts focused on increasing scrutiny of high income partnerships, corporations, promoters that are basically abusing tax rules on the books. They're coming after them.
Yeah. Not only that, there's been a lot of new stuff put out by the IRS that they're going to change some of their compliance letters that they're going to send out as well, right? But I want everyone to be aware. I don't care what the law says. The law says that they're going to target these big partnerships.
And we're going to talk about that in just a second. Yeah.
Let's not get fooled. We're going to talk about it here in a little bit about how many audits are really on the high net worth people versus the middle class.
Yep.
And we all know what that really is, right? And the reason why that is there's more middle class than there is high net worth individuals.
It's a numbers game.
So it's a pure numbers game. So people that think, oh, this $80 billion is going to go after that, all those millionaires and billionaires. Don't be fooled.
No, do not be fooled. They're claiming this is their strategic operating plan that they just released, the $80 billion in funding. Rick, we've seen this too many times, right?
Yeah. They go after one big fish and then they go after all the little fish.
Yep.
And that's what this is about, guys. Don't be fooled by anything.
Yep.
They maybe have 2 or 3 big companies that they want to go after, but the rest of that money is going to go to agents coming after you.
Yeah. And so, some of the things are good with this $80 billion that they're doing, right? And if some people are doing some unscrupulous things, I don't really have a problem with them going after those individuals. But some of the things is, compliance assurance processes. They're supposed to have better customer service. I think we've seen a little bit of that, but it's a work in progress.
They're still recovering from the COVID debacle.
Yeah,
okay.
it's
So,
tough.
we all remember 2021 and even the early part of 22, you literally couldn't get a hold of a single person at the IRS.
Ooh, it was bad.
Yeah.
It was bad. But then they started allowing us to email.
Yeah.
Where they didn't used to do that before.
Correct.
Everything had to be fax transmission or over the phone or mailed in the mail. So things have changed a little bit, which is kind of good. But yeah, so basically they've kind of driven up 3,700 new employees, special task force. They're utilizing AI now to capture some of these audits for partnerships and things like that. The sad thing is we know, though, while some of this will help their processes, technology makes mistakes all the time.
Yeah, because they just go off of whatever, standards that they program with the AI bots, right? So the AI bots go off of an industry. You go in, that return has an industry code on it, and they're going to pull up whatever industry standards say that this should look like. And it's a machine. It doesn't have the ability to independently think. And it's going to see this and go, well, if it's this, then it should look like this, and nothing looks like this. So we're flagging it. Now you're under an audit, and there may have been nothing wrong with your return.
Yeah. And so that's what I want people to understand, right? Is you could have done absolutely nothing wrong. But in the IRS's eyes, they have a job to do, and they're going to try to do it to the fullest. And they're going to investigate it. And when they investigate it, it's going to be typically a very long, drawn-out process.
Yeah.
And you, as the taxpayer, you can certainly represent yourself. I wouldn't recommend it. But if you're going to hire somebody, whether it be a CPA, an EA, a tax attorney, it's going to get very costly.
Yeah.
I'll be honest with you. There hadn't been too many audits I've represented that took, less than 10 hours. I mean, it takes some time, Rick, depending on how invasive that is. And depending on what that hourly rate is, it can be very costly.
Yeah.
So,
and be careful, guys, because, just because you get selected for an audit, as I said, there may be absolutely nothing wrong with that return, right? And I see this all the time where you've just been selected, right? And here's a letter, and we just want to verify some stuff. Be careful about going back to whoever prepared that return and kind of pointing the finger at them and going, well, what did you do wrong? They may not have done a single thing wrong. You may have just gotten selected for an audit, right?
Absolutely.
And then the bad thing about it is the taxpayer bears the burden of not only substantiating everything, but then paying to cover the cost of that audit, right?
Yep. And here's the deal. Just because, you had a preparer prepare your return doesn't mean that preparer is qualified to represent you.
That's right.
Okay. So you got to be careful with that. You have to have specific credentialing to actually represent the client.
Yeah.
Okay. Another area that they're ramping up, and I think you and I met with someone the other day about this, guys.
We did.
And y'all have seen this on TikTok. Everyone has seen this. Is they're going to start ramping up the audits for private jet usage.
Yeah.
Okay. Everybody's going to want to go buy a new private jet. It's on their radar, Rick.
Yeah.
It's on the radar. It's ramping up audits of corporate jets to collect more in unpaid taxes. So they're going to push increased enforcement towards those wealthier taxpayers.
Yeah. I mean, this is purely, it used to be the yachts, right? People that would buy the yachts and run it through their business. Now it's the private jets. But it's basically, you got to have a legitimate purpose for buying a jet and running it through your business, right? And it can't be just so that I can fly the family to Disney World next month. It's got to be in the business, being used by the business, more than 50%.
Yep.
And, there's all kinds of rules about, where it's got to be located and things of that nature. But, just be careful for declaring any kind of use of an object that looks like it's going to be mostly for private use.
Yeah, for sure. I mean, IRS Commissioner Danny Werfel came out and told the reporters the other day that, one of the things is they're concerned about is executives and shareholders that are utilizing these corporate private jets per se for personal reasons, for that specific reason. Mm-hmm. And then that would essentially claim income for them because they're receiving
a
benefit for being able to fly for free.
Yeah. So it's basically it falls under the fringe benefits thing.
It does.
Right?
It does.
And there's some specific rules on what a fringe benefit is and how it can be excluded out of your income. And there's thresholds, and those dollar thresholds are not very high. And you think about the cost of a private jet, just even one flight, what it would typically cost, it's going to exceed a fringe benefit threshold.
Yes, it is. Yes, it is. So kind of backtracking a little bit, I know our slides are just a little bit off on this regard, but you were talking about earlier, Rick, about, hey, don't buy it completely. Like they said, we're only going to target people making $400,000 and above. I think that's what Biden had come out and said. I don't buy that at all.
Nope.
Historically, here's a chart that we have right here. And you can see right there, as far as audits for wealthy people had actually, if you see that, had actually went down in 2020 and 2021. It started to go up just a little bit in 2022, but they were saying the same thing at that time as well.
Yeah.
And so, guys, I would just, side on be a little more cautious, make sure that who's preparing your returns can represent you, that you're crossing your T's, dotting your I's, and don't be oblivious. Don't be naive thinking that if you made 200,000, 100,000, 250, that you're off their radar. I wouldn't say that's not true at all.
No.
I'm sorry. I know there's information being published out there about it. I have a hard time believing it.
We hear this refrain all the time from the government that we're trying to go after the big bad millionaires that don't pay their fair share of taxes. And the truth of the matter is, it's easier to go after the people that just have a couple of $100 in their pocket than it is to go after the people that have millions in their pockets.
They can't afford representation.
That's right.
It's low-hanging fruit.
Yeah.
Sad, but it's true. So this leads me into what we talked about. Your preparer may not have the ability, right, to protect you. One of the things that we offer at our firm, and we do make it selective, okay, but we highly, highly recommend it, okay, because if you're ever chosen for an audit, it is extremely expensive.
It is.
Okay. And so what we do is once we file your tax return, if you check the box and you say you want us to represent you for a small fee, we're not going to go over that here, but if you call our office, we're happy to go and disclose that information. We'll represent the client for up to 3 years on a federal or state return.
Yeah.
And we have a whole team of CPAs, EAs, tax attorneys who will do that for us, right? That they specialize on audit transactions that come up, whether it be from the IRS, the different state divisions, or any just small notice that comes about as well.
Yeah, well, that's the thing is it's not, most people think audits is going to be this big thing. You can just get a letter from the IRS that says,
that's right.
We have a question about this one item on your tax return. Well, guess what? Someone's got to call that IRS agent and go through it with them of what they're asking about, right? Yep. It may not be an in-depth audit where you may not even have a small business. You could just be, maybe I cashed out a 401k.
Yeah.
And they want to know why you didn't pay the 10% penalty on it.
Yeah. And guys, and I'll tell you, if you get a notice like that and you decided, hey, you were one of our clients and you needed us to, respond or handle that, I mean, that might be an hour of our time, could very easily cost you $400, $500, $600.
Yeah.
Okay. Whereas this is a fraction of that. And we have a whole team that's all they do. That's all they do is they handle audits. They handle notices, and they do this for every one of our clients. So I highly, highly encourage you to find you a CPA, an EA, some type of a preparer who has that system in place, right? But, these people have been doing this for, long, long time, Rick, and some of the best in the industry.
Well, yeah, and that's the thing. These small practitioners that maybe it's just a solo shop and you have one CPA in there. Maybe he only has 100 clients that he's filing for, right? But if you're in the middle of tax season and you get an audit notice, is that CPA going to stop his tax practice to call the IRS for you? No, he's going to go, I'm in the middle of tax season. I'm going to have to wait, or you're going to have to find someone else because I can't put all the rest of my clients off. We've done the work to put people in place that can handle this. Doesn't matter what time of year that letter comes in and it'll get taken care of immediately.
That's right. That's right. And it's for no additional cost, and it's going to come up for 3 years, both federal and state, right? I can't emphasize that enough. If you make a mistake on your federal return, you're going to have a mistake on your state return.
That's right.
Okay. Because these are through allocation and apportionment. And what's going to happen is basically that income is allocated to that respective state that the income was generated in.
Yeah.
Okay. Very, very important. Well worth it. I can't emphasize it enough.
Yeah.
All right. So here's a tax-free supper money. Okay. So basically, this goes for individuals who are working overtime. Okay. It does pertain to both employees and employers. Okay. Rick, I'm going to let you kind of take some of this over right now if you want to.
Yeah, no worries.
Okay.
This goes right back to what we were just talking about, fringe benefits, right?
Yes.
So, there's all kinds of fringe benefits that are out there, and each of them has kind of a dollar threshold of what it falls under. This is purely for the employer that maybe you have, I'll use us. Tax season means overtime for a lot of our employees, right? And so they're up here, and many times we'll buy dinner for them, because we don't want them to be out of pocket because they're up here working.
And they'll continue to work all the way through it.
That's right.
Too.
Now, typically, any kind of a benefit like that's provided to your employer could be taxable income to you, unless you can get it qualified as a fringe benefit under a certain plan. And so one of the things that we do is we make sure that we have within our operating agreement for our LLC that we have defined what fringe benefits we're willing to cover under our company, what the dollar thresholds are, right? But these plans have to be documented. They have to be documented. And two, it has to be within a certain threshold. And in this case, it could be $30, it could be $50, whatever it is that per employee.
And it needs to be reasonable.
It has to be reasonable, right? So we're not talking about taking someone out to a fancy steak dinner that you're spending a couple $100 on. We're talking about a reasonable meal that you would provide to your employees.
Also, the one thing that's key here, Rick, is if they work an hour, 2 hours, you can't tailor the dollar amount to how much time that they work overtime. Either it's a meal or it's not a meal.
Right.
Okay.
That's right.
So you can't go, okay, as an example, what we have up there for number 4 is $30 allowance per hour for overtime is a no-no. Now, if it is $56 or any one given, person works 1 hour or 4 hours, that's okay. And to kind of go over those 4 rules, Rick, you want to go ahead and hit on those?
Yeah, sure. So this is a benefit that you're giving occasionally. This is not every night I'm buying supper for my employees.
Exactly.
Okay. If you're doing that, you're providing income to your employees. This is maybe every Wednesday I buy dinner for all my employees because we're working busy season every night, right? But Wednesday nights I provide them an extra a meal, right? It's got to be reasonable. Again, taking people out to Morton's for a steak dinner is going to be a no-go.
Yep.
I'm bringing in pizza, I'm bringing in sandwiches, whatever it is. And it's basically there for them to work overtime. It's not for everybody. So if you've got employees that aren't working overtime, okay, they're not actually eligible for this benefit. Okay. And this goes to your hourly employees, right? Not necessarily your salaried employees, but your hourly employees. If you're paying them an hourly wage and they're not qualified as an overtime employee, you can't not provide this benefit to them without it becoming taxable income to them, right? Per diems actually will work best for this, right? So you basically set it up inside your operating agreement that says we will pay a per diem of up to, call it $20 for a supper if you work 45 hours during the week.
Yep.
Right.
Yep.
And so that gives you that ability to buy a meal for your employees and be able to, take the deduction, but then not include it as income on the employee side.
Yeah, absolutely. So those 4-prong tests that has to be met, all 4 being benefit has to be occasional.
Yep.
Right. Number 2, it has to be a reasonable amount. It has to, number 3, it has to enable the employee to work overtime. And number 4, it can't be tied to how many hours that they work.
Correct.
Right. If any of those 4 rules are not met, it is a violation. And then it becomes income to the employee, right? That is subject to withholding and payroll taxes. But for the employer, it's 100% deductible. So the employer is fine with it. But The employee, not so much. Now they have to claim that as income.
That's right.
You got to be very careful. All 4 tests have to be met or you're in violation.
That's right.
So, okay. So number 10, and just so everyone knows, we have 15 different topics we're talking about today. If you happen to overfund a 529 college account, there's a few things that you can do. Yeah. You can change the beneficiary. For instance, you can change that to a spouse, a sibling, a step sibling, first cousin or spouse of a cousin. You know, you can take, you don't have to always use that for college. And most people set up 529s for college. What you can utilize that for is you could utilize that up to $10,000 for any tuition from K through 12. You could drain the account, but then what you're going to have to do is you're going to have to pay taxes on the earnings as well as a 10% penalty if you do that. Mm-hmm. You could roll that 529 over to an already established 529 that is a beneficiary member. You could even utilize those 529 plans for a registered apprenticeship program. Mm-hmm. Okay. They've broadened it up a little bit. You could utilize tax-free withdrawals for principal or interest payments that are associated with qualified educational loans. Okay. But please note that if any of those activities that you decided to do for the overfunded account is, if that account was funded by a custodial account, you cannot do that. It is illegal. Okay. You cannot take money out of a 529 that was initially funded by a custodial account. So just kind of FYI, guys. Okay.
There is, not on that point, but there is something out there, and this is where you really need to get a tax professional to help you. There is a way to overfund a 529 account and spread those overfundings over a period of 5 years.
Yes, very good. Yes,
and we work with people all the time on that. Of maybe you just got a huge inheritance and you want to go ahead and set up your college plan for your kids right now.
Yes,
so that money can already start working for them. There's a way to overfund those things right now and spread the contributions out over a 5-year period and not invalidate your 529 plan.
Yes, absolutely. Okay. This was one that comes up. Are you considered a professional gambler?
Not me.
I don't gamble. I'm the same way. I like sports too much. I like the purity of the game. I would not risk anything. And quite honestly, I'm not good in cards.
Well, I'm terrible at it. I'm terrible at guessing at things and doing that. Now, that doesn't mean I won't play a nickel slot or something like that every once in a while, but no. But
honestly, I think the last time I was in Vegas, I was there for a business conference and I was there for 5 days. And I realized on day 5 before I was about to fly out that I hadn't gambled $1.
Yeah.
And so I literally sat there, ordered a burger and fries. And I think I put $5 in the slot machine and I lost that in 10 minutes. And I was like, okay, I've done my take.
Yeah. I was just there. I was in Vegas last month for a family thing. And I remember checking into the hotel and walking straight through the casino and going, none of this interests me.
No, the food and shows are much better.
That's right. Yeah, absolutely.
But yeah, so there are preferential treatment that is done for professional gamblers versus recreational gamblers.
Sure.
Rick, you want to talk about a little bit of these different things and what qualifies?
Yeah, I mean, so
it's not easy.
So you've got to document. Documentation is always going to be your number one thing, right? So to be a professional gambler, you have to show that you gamble on a regular basis. This is not, I go to Vegas twice a year and I gamble, so I'm a professional gambler. Nope. You have to basically show that this is your profession. Mm-hmm. This is something you do on a regular basis, either weekly, monthly, whatever. And this is where you're generating significant income for yourself. Right?
Yeah. So the purpose is to earn a profit.
That's right.
Right. And so there's a 9-factor test that determines this, and some of these things are your winnings or losses.
Yeah, winnings and losses, but maybe you have a couple of good runs and you make a lot of money. That doesn't necessarily qualify you as a professional gambler, and that's you have to be careful on that. Where you go, okay, well, I went to Louisiana and won 3 times in a row while I was there, and I made $100,000 because I hit the jackpot. And because I go every couple of months, I'm going to call myself a professional gambler. Yep. Nope, that's not the way it works.
Yeah, I mean, typically when we see people that are professional gamblers, I mean, they're gambling 3-4 days a week. Yeah. Pretty religiously almost,
And you have to be careful about the state that you live in because, we're here in Texas. Texas does not recognize gambling.
Nope.
It is not legal here.
Nope.
So we do have a lot of people that will drive to Louisiana or they fly out to Las Vegas on a regular basis and they are professional gamblers, but they don't do it here in the state of Texas.
Yeah.
So you have to be careful about that.
And they want to, and one of the things they'll look at, they want to look at your expertise level at it, right?
Yep.
So, and kind of how you conduct yourself. If you're not, it's a business, right? In a sense, if you're a professional gambler, you have to represent it as a business as well.
Yeah.
Okay. So it's how you're representing things matters. So, one of the items we have here is your court cases show the single most important factor is keeping good gambling records.
Yeah. And that's why I said it goes back to that documentation. We recommend, just like with any other business, you have a separate bank account. And that's where all of your funds go for your gambling. Yep. But again, we don't want to be mixing personal and business stuff.
Nope. So you're constantly educating yourself about gambling. You're going to, if you start to lose, you're going to be changing the games that you're gambling, right? Because that's what someone would do in business. If they're making poor business decisions and they're losing, they're going to pivot and start doing things that's going to generate more profitability for them.
Correct.
Okay. You're going to keep track of your wins and losses. Your financial status also matters, your expertise, and the time and effort that you dedicate towards gambling.
Yeah. Again, this is document. Keep a calendar of all your traveling. Mm-hmm. Make sure you keep a journal of where you've gone, what you've wagered, how much you won, how much you've lost.
Yep.
Treat it just like you would any other business. Create a financial record for yourself.
Absolutely. So number 12, we're talking about the IRS Dirty Dozen every year or so.
Every year.
The IRS comes out with their Dirty Dozen. So what we have up here is just 6 of them that Rick and I just poached off the internet, compiled together per se. But every year the IRS comes out with these. These are things that is on their radar, identifying scams and avoidance schemes that we should all look for. These false ERC claims is probably one of the biggest right now that's going on, Rick. People are abusing that big time. And, we've had so many people approach us on it. And, that's something Rick or myself would never sign off on.
Yeah.
And they said, well, we were contacted by this ERC company that said they could get us back X, Y, and Z. And we go to bat against that pretty darn heavily. I know that in our practices.
Yeah.
We're like, be wary, people.
Yeah. We've had several of our clients hit up by these phishing calls of, hey, we can get you $28,000 per employee, blah, blah, blah. And,
yep.
One of the things that I almost always look at, first of all, is do you even have employees, right? Yep. Contractor is not an employee.
Does not count.
Right. And so that's where a lot of people get under this delusion that they're going to get hundreds of $1,000s from the IRS is I'm running some kind of contractor business and I've got 10 contractors that work for me and I'm going to get $28,000 for each of them. No, nope. They're not employees.
Exactly.
So be careful. And for those that have filed ERC claims at this point and they're wondering where my money is, the IRS is still on hold and processing a lot of this stuff because they had so many scams claims.
Yeah, absolutely. So, just to kind of run down these real quick, phishing and smishing, fake communication scammers that are out there, fake charities, be careful. Someone will say, hey, make a donation. I'll give you a receipt for it. But are they a legitimate 501c3?
Correct.
You need to check into that. This is one. Offering compromised meals. Man, those guys are all over the radio, on the TV, aggressively promoting for those that don't even qualify. Oh, we can get you an offer in compromise. Those are pretty straightforward, Rick, but they're basically saying that everyone's going to qualify. And that's just not the case.
Yeah. If you owe taxes and you get hit up by these companies that say, we can save you $10,000 if you'll just give us a little bit of money now. And we had one here in Houston, right, that was pretty big and got caught. They were charging people $5,000 up front and not doing any kind of representation at all.
Well, yeah, one of our clients actually, we had didn't touch base for a number of years, and he ended up going to one of these on some filings that he had done on his own, and got himself into a little bit of a pickle. And I forget how much, $5,000 or $10,000 he had paid towards that same one, and they just took his money, didn't do anything for him, and then he calls me up and says, "Hey, Jake, I don't know why I didn't call you from the beginning. And we took care of it for him. But it was really unfortunate because he lost everything he paid that company. And they just kept saying, we need another infusion. We need another infusion.
Yeah.
And nothing was done. So
the IRS doesn't just willy-nilly wipe out tax debt.
Yeah.
And that's the thing is everyone thinks that, well, there's this offer and compromise system out there. And that if I just owe money, I can somehow negotiate with the IRS to lower how much I'm going to pay them. That's not the way it works.
It is so frustrating to me when I'm just, scanning on TikTok and I see, all these ads that are ran. It is so fake. Look, guys, if they're going to negotiate with you on an offer and compromise, it's very clear, like you don't have the ability to pay them.
Correct.
Like you don't have the assets, you don't have the resources. And most of the time those people are unemployed, right? Yeah. So that's when they negotiate. But what happens with most taxpayers is, those notices start coming in the mail one after another. They bury their head in the sand. They don't respond because they don't have the means to pay for it.
Yeah.
And then they get on their feet, right? And then they get a good job and they go, okay, now I want to address it. Well, unfortunately, in the IRS's eyes, now you have the ability to pay.
Yeah.
So they're not willing to negotiate offer and compromise at that time.
Yeah.
When you couldn't pay was the time to actually negotiate with them.
Yeah.
Okay. So a lot of bad information out there for that.
I typically see this when someone gets a huge windfall of money in 1 year.
Yes.
Right. Maybe you got an inheritance. You inherited a company. Right. And yeah, you got to step up in basis, but then you sold it and got more money out of it and you owe this huge amount, but you spent that money already. Yep. Right. Well, if your circumstances didn't change, you still have a nice job but you're not having this windfall every year. It doesn't matter. They're going to look at your circumstances and go, well, you had the ability to pay. Nothing really changed for you. We're not going to lower your tax debt. It may take you 10 years to pay that off, but we don't care. That's the way the IRS looks at it, is if you have the ability to repay at any point, you're going to pay the amount and they're not going to negotiate with you.
That's right. That's right. Social media, fraudulent form filing and bad advice. So one of the things that we have this podcast for people is we're trying to give you good advice, right? Yeah. And so you don't, catch your butt in a pickle there. So we want to make sure that we're giving you good information, that you're not making poor decisions on bad advice that people give you out there. And then number 6 was the false fuel tax credits. People claiming that, right, for these off highway vehicles and farm use vehicles that they don't even have a farm or they're not going off highway. And
my favorite is the guys, especially here in Texas, that have these big trucks and they think they're going to claim this fuel credit because I have to spend so much on diesel in my truck. And
right.
You're not a farmer.
No,
you don't get to claim it just because your truck is a heavy duty truck that uses diesel.
I mean, they might be at the rodeo now. We have the concrete cowboy.
Yeah.
Good stuff. Good stuff. Okay. So earlier we were talking about those scammers out there in the ERC. So one thing that's really cool out there, guys, is the ERC claim that if you've done one that's improper, so they've set some new regulations in there that are going to expire here pretty soon. Okay. But if you are proactive and they have now set channels up there that you can pay back 80% of your ERC and still keep 20%. It's pretty darn good. Okay, Rick, that's pretty good. You say, hey, I improperly claim this, right?
Yep.
I'm going to hand you back 80%. You get to keep the interest and that 20% becomes tax-free. That's a pretty good deal. I know a lot of people aren't going to want to give up that big credit, but if you do, they're going to want some additional information from you, Rick. You want to hit on some of that additional information that they're going to want?
Yeah. Basically, they want to find all these bad actors.
Yeah.
That's what this is all about. So if you got suckered into, and I hate saying that, but if you got suckered into one of these promos from these people that said, yeah, we're going to get you, again, $28,000 per employee, and you should not have claimed that credit, right? And so let's say you claimed 5 people and you didn't really have 5 people and you got $140,000 tax credit back from the IRS. And they're going to say, okay, if you recognize that you probably shouldn't have got that, we want you to send back 80%. So you're going to send back $112,000 plus a little bit of interest back to the IRS. You get to keep the rest, but you're going to provide them the information of who did you actually work with to file this with?
Exactly.
Okay.
And you have to do that by midnight of March 22nd, 2024. It's coming up, Rick.
Yeah.
And there's going to have to be a specific form you have to file, which is the form 15434.
That's right.
Okay. If they choose it, that they agree, okay, they have the discretion to deny it. But if they accept it, they will send you a closing agreement that you must sign and get back to them within 10 days. So you've got to have a quick turnaround. And once you do that, when you remit that 80% payment, it has to be done through EFTPS.
Okay.
So all of it has to be done through EFTPS. That is their payment system for payroll. And so that needs to be remitted back through there. I sure hope those people didn't utilize those funds, because I know a lot of people that did those things that were going to those privileged preparers.
Well, I can tell you right now, guys, the IRS has the discretion of whether to let you do this or not. It's not a done deal. It's not I shouldn't have done it. Here's my 80%, and you walk away scot-free. The IRS has the discretion to go, you willfully and knowingly did this and abused this. And who they're really going to go after is these people that claimed 20 employees and got, $500,000 out of the IRS and knew they didn't have 20 employees.
Yeah. I mean, you're going to have to be not complicit with it. You're going to have to not have known that this has happened.
Correct.
Was in it incorrectly advised.
Correct.
This, okay. Because if you were advised and you knew it, or you were lying to your preparer.
Yeah.
That's the other deal.
Yeah.
If you were lying to your preparer, because they're going to go back and do an investigation.
Yep.
And that could backfire on some of these people, you know? So anyways, be careful. It is out there. Just wanted to let y'all know if that did happen and you are innocent, make sure you file that by March 22nd. I would get with your CPA, your preparer, whoever that person is. If you don't have one, give us a call. We'd love to help you. But we got to move fast.
Yeah.
Okay?
They're going to start coming after people. And so
are.
that's one of the things that if you think you're on the fence and you're not sure, I would definitely recommend you get with a preparer or a CPA or even an attorney, because they're going to start looking at all of these claims.
Yep.
And you don't want to be the one left holding the bag.
That's right.
Maybe you're an innocent bystander. Maybe you got caught up in one of these scams and you thought you really qualified.
Yep.
Okay. And now you're going, I don't know, but I'm just going to let it go. There's people going to jail on this.
Yep.
Don't think that there's not. There's people going to jail because this was billions of dollars that were scammed out of the IRS on these ERC claims.
Yep. Absolutely was. So I know we talked about BOI earlier, and this probably should have been back then, but we're going to kind of hit on just some Q&A, right? And some of these are, do you have to file a BOI report if you own a single rental property in an LLC? The quick answer is yes. It is an LLC. It's registered in the state.
Correct.
Do you have to file 10 BOI reports if you own 10 LLCs? The answer is yes. Those are 10 separate registered entities.
Correct.
Can a certified public accountant, enrolled agent, and non-lawyers file BOI reports for clients without running afoul of unauthorized practice of law rules? That is unclear. They have not disclosed what that information is. I can tell you that they will probably make a ruling on that sometime this year. But in the meantime, get with someone. I would say that those are the people who's going to be able to do the best, your CPAs, your EAs, or attorneys.
Yeah.
Okay. If I don't know who else would be the one that's qualified to do it outside of that, those would be the ones that would be the most qualified.
Yeah. I mean, outside of the people doing it for themselves, right?
Yeah. Outside people doing it for themselves. Are registered agents responsible for filing the BOI? The answer is no. Okay, so what a registered agent basically is they just receive information on behalf of the company. So if someone decides to sue the company, the registered agent is going to be served by the process server.
Right.
But they're not responsible for that.
Right.
Do self-employed people have to file? The answer is no. Now, I'll give it back up a little bit. If they are a disregarded entity, they are self-employed at that time, those individuals would have to. So really the key element is the registration in that respective state. Do I need a street address in the BOI report, Rick?
Yes, you do.
You do.
PO boxes are not acceptable.
That is
correct. It
correct.
has to be a physical location.
Do I need to list my social security number in my BOI report?
You do not, but you do have to list the EIN of the company that you represent.
That is correct. Do I need to list my attorney in the BOI report? Maybe, and I'll tell you why. Right? Yeah. Like I know when we were filing those reports, whoever filed the report, you have to put their information. So if your attorney's the one that prepared that BOI, I would say, yeah, you do. I never saw anywhere else on there would it ask for an attorney or anything like that on the BOI reports. Must I file an updated BOI report if the beneficial owner leaves the company? Yes. Anytime one leaves or a new one comes on board, you need to update it.
Within 90 days.
90 days, people. 90 days. Or it's 591. 591. I got those crossed. 591 per day. Do I have to list my minor child in my BOI report?
No.
And then will criminals file a BOI report? Who knows what criminals are going to do at the end of the day? Yeah. But the reality is if they are a criminal or not, and they're running a business and have an LLC, a corporation, a partnership, anything that's a registered entity, they need to be filing it. It doesn't matter if they're a criminal or not. They still have a requirement, and BOI is going to hold them accountable for it.
Yeah, and FinCEN's going to run through the IRS, so they're going to know all of these returns, corporate returns, partnership returns, even your personal returns that have the Schedule Cs with the LLCs listed on them. They're going to have a list, and they're going to see whether they're going to cross-reference and see whether all these entities have been filed or not.
Yep, absolutely. So this is going to be the last topic we're going to talk about. It's on NFTs. I know when NFTs were coming out, they got real popular for a while. I never really got on board with much of it. I'll be honest with you. One of the guys I watched quite a bit of his stuff, Gary Vaynerchuk out there, Gary V, had some Gary V friends. It was on Discord. I watched that for a while and followed some of that. Really had a hard time wrapping my head around that. But nonetheless, a lot of people have invested in NFTs. Mm-hmm. And so an NFT stands for a non-fungible token. It's a digital asset that can be bought or sold. That could include digital art, including drawings, paintings, photographs, different types of media, collectibles such as trading cards, sports memorabilia, limited edition toys can be an NFT, gaming NFTs, music. I know there was a musician that sold $1 million with, I forget, it was like one day or maybe a couple hours or something. I don't know who it was, but he did that through an NFT. Virtual real estate and virtual worlds, domain names, things like that. So the IRS deems these NFTs as collectibles, mm-hmm. Rick. Do you want to talk about that? Why this is no good actually for some taxpayers?
Yeah, because you get the worst tax rate on this.
Yes.
Yeah, there's no graduated system. Collectibles are all taxed at 28%.
Yes, they are.
Flat. And so, and maybe that's your only source of income.
Yeah. And so if it was another form of an asset, right? And, like a long-term asset or something, like a stock or something, that could be 20%. Yeah. But because these are collectibles, that's 28%.
That's right. So, this isn't kind of a terrible ruling for anyone that's wanting to get into this as a business, because as of right now, all of that income that you could be generating off of your NFTs could be subject to a 28% tax bracket on mm-hmm. all of your income, right? So make sure you're with a good preparer helping you structure an entity if this is the kind of business that you're trying to get into to look at some of these things. I'm with you. I never really got into the NFTs. I understand them a little bit, but
yep.
I do, unlike say like a Bitcoin or something where there's some kind of paper trail behind it and there's a value system behind it. NFTs don't really have that kind of back currency behind it.
Yeah. And one of the things that I didn't like as well is people were looking as this as an alternative investment, right? And they had a retirement account and they decided to purchase NFTs with their retirement account. So what's going to happen is it's going to be booked as a distribution from your retirement. Okay. They're going to issue a 1099-R. So the amount that you purchase with your retirement is going to be booked as a distribution, which is going to be taxable. And if it's a early distribution, you're going to have 10% penalties, right?
Right.
So you got to be very careful in that. It is still going to be for capital gains and things like that. So, gains are going to offset losses in that respective field. With that being said, a lot of NFTs, they were purchased, right, with cryptocurrency.
Yeah.
So that becomes a taxable event when you purchase that cryptocurrency to buy that NFT as well. A lot of people don't realize that, okay? So you got to be very, very careful. Now, let's say, Rick, that you're not buying or selling these. Let's say that you are the creator of the NFT. Then what?
So if you're creating this digital content, right? That's basically what it is. It's digital content. You basically have a business at that point. So you're going to be treated like a business. Buying, creating it and then selling it is going to be subject to business type ordinary income gains and losses, right? So it's not a capital item. The people who are buying it from you, though, are going to be subject to these capital gains and losses on the collectible side, right? Now, you have to be careful. If you create this content,
business,
it becomes a business, right? But you don't turn around and sell it. Let's say you have inventory of NFTs, right? And there's no defined legislation on this yet, but I guarantee you it will come out eventually. Does that inventory create regular inventory and therefore subject to gains and losses, ordinary income, or does it become a collectible at that point because you didn't turn around and sell it immediately? And so then it's a collectible that you're holding on to and is now subject to 28% sales.
That's a good question. I don't know. They haven't given us enough guidance on that yet. And I'm sure we'll get some hopefully in the very near future. But, anytime you're dealing with these new alternative assets, I typically I'm a little cautious on it, right? So IRS is going to typically crack down on it pretty hard when they do make a decision because they realize, and that's why they booked this as a collectible, they realize that some of these people were sliding on the radar for a while, right? So if we're talking about like money laundering, like a lot of paintings and stuff or transactions are done through money laundering for that. And so these NFTs were doing the same thing.
Oh, yeah. Just give me $1 million and here's this digital piece that is probably worthless.
See, and that's why I had a hard time wrapping my head around the business. I was like, who would pay for that digital monkey?
Right.
That ape, that was what it was. They were apes. And I said, who's going to pay $1 million for a digital? I wouldn't pay it for something tangible I could hold in my hands, you know? So I'm sure there was a lot of
money laundering, just like with anything else.
A lot of nefarious crimes going through that. Yep. So be careful, guys. And then realize if you are a content creator of it, but you're not really a business, it could be considered a hobby for you. You still got to claim it as income, right? But you don't. If it's a hobby, you don't get to claim any of the deductions.
That's right.
So you got to be very careful on that as well. And then the last area was basically the gas fees. If we're talking about you're a purchaser or something like that, it's just going to add to your basis. If you're a creator, those gas fees are going to basically just be a business expense. Right. That's going to come right off.
Just like any merchant service fee that you would take, right?
Yeah, absolutely. But, I think all in all, we kind of covered quite a few topics today, Rick. I want to thank you for sitting down with me. And I always enjoy these very thoroughly. Hopefully all of y'all enjoy all of this. Hopefully we covered some bases. If there's some things that seem unclear, if you'd like us to dive a little deeper into it, feel free to reach out to our office. Our office line is 281-288-0909, or you can also look us up at lytaxadvisors.com. I'm Dr. Jake Latimer, and this is Rick Yancy, CPA. Hope all is well, and we'd love to hear from you if you can give us some feedback. Thanks so much. Have a blessed day.